Well, no one can deny that the markets are in turmoil. That's why we have record numbers of high producing real estate agents looking at notes for creative financing strategies to give themselves and their sellers more options in this crazy market. We have burnout landlords, wholesalers, professional investors all looking to notes as ways to sell off some of their inventory and or continue cash flow. It's a crazy time, and our guest today, Joe Varnador, has seen this many times over his last 30 years. He's an instructor for Noteschool, and he teaches these folks, as well as just anybody who's interested, how to use creative financing strategies as well as notes to increase their wealth. And we're pleased to have him today as our guest. I think you're going to learn a lot. We'll be back in about a minute, and we'll get our program started. Thanks for joining us today.
Real estate has created more millionaires than any other form of investing. But how is that working out for you? Did you become a landlord and invest in rentals, expecting monthly cash flow? Only to become burned out, with all of the headaches of tenants, toilets and turnover? Are you shut out of the game by high prices and tough lending conditions? Is all of your investable capital locked up in a retirement account, and you don't know how to put it to work in real estate? Well, you've come to the right place.
All right, welcome to episode 4 of the No Club USA Cash Flow Podcast. My name's Tom Forrest. I'm your host and founder of No Club USA. And if this is your first time joining us, I want to welcome you. I want to get you caught up real quick on what we do and also respect the time of the people who've been here beforehand. But what we do is we buy mortgage notes and collect payment streams. It's essentially becoming the bank. And in episode 1, you can go to noclubusa.com and go to our podcast archive and catch up on the previous ones. But in episode 1, I talked with a gentleman who's a CEO of a hospital in Wyoming. He and I share a common goal of wanting to be able to retire with adequate cash flow. And we talk about how we did that. I've done it on my own, and our guest did the same thing. So that was the focus of episode 1. Of course, when you talk about these things, the question comes up, what happens if they stop paying? Well, that was the subject of episode 2, and I had a great guest, Dr. Emily Thompson, who talks about how she made lemonade out of lemons when her borrowers stopped paying on the loans. And honestly, the big secret is that it's not that big a deal. When we buy notes, when we put ourselves in a lending position, we do it with such a strong position that no matter what the outcome, we're going to come out ahead. So in episode 3, the last episode, which aired March 10th, we had Derek Long from Quest Trust Company on. We talked about tax advantage investing because notes do cost some money. You know, they can be relatively inexpensive in the $15,000 to $20,000, which is for an investment is fairly inexpensive. They can be up to over $1 million. But Derek unlocked some of the secrets of using your retirement funds as well as Roth IRAs and health savings accounts and even Coverdell savings accounts for minors to unlock the ability to invest in notes as well as other investment vehicles, and great feedback on that particular episode. So please go back and watch those, get caught up. I'm going to have a little classroom session today where I'm going to touch on performing note really quickly. But in terms of some of the questions that I've gotten recently is, okay, so let's say that you've built up your bank of notes and you got some nice cash flow coming in. What now? What happens if you need some money all of a sudden? Just like you have a whole group of rentals and now you're kind of cash poor. You're getting a little bit of cash flow, but you need something, say an emergency came up or something like that. You go off and sell a house, that's probably kind of hard to do. But with notes, there's a lot of liquidity. And so that's one of the questions people have when they're looking to pull the trigger on notes is, how do I get my money back out? So anyway, we'll address that today in today's classroom session. And then our guest, Joe Varnador, is an instructor with Noteschool. He's one of my mentors. Eddie Speed's right-hand man. If you've been with me on any of these podcasts, you know that I consider Eddie the king of note investing. He runs Noteschool, been doing this for 42 years now. And right now, his speaking engagements are through the roof because let's put it this way. When conventional lending dries up, seller financing steps in to fill the void. And right now, more than ever, everybody wants to know about creative financing, getting more deals. There are fewer qualified buyers out there. Credit scores have now had to go from 740 to 780 just to get a QM. So things are happening out there and people are stuck with properties they can't unload. There might be a tax situation if you're a burnout landlord. There's all sorts of aspects that really start to come to the forefront when you know about notes and how to deal with them. And so Joe's going to talk with us today about what he's seeing with these folks, and hopefully you're in that category and you're really interested. So I'm going to take a short break here. I'm going to move us into the classroom and get started. We're going to go over what happens when you have a bunch of notes and you need to cash out, how a note works, and then we're going to move on to our guests. So stay tuned. I'm going to take a nice 30-second break here, get some water, and we'll get started. Thank you for joining us today. I think you're going to learn something. Okay, so we're going to be in the classroom very briefly. We're going to talk about what to do with notes once we have them and we need cash. And we're going to talk about liquidity. That seems to be a question that I get quite often is I have a bunch of notes and what can I do with them if I need cash? So first of all, obviously there's the disclaimer I have to put up. There's no safe investment according to the SEC. And of course, you've seen this disclaimer before if you followed us, but I'm not a lawyer, CPA, or financial professional of any kind. This presentation is simply for entertainment and educational purposes. Any results displayed herein are not to be considered typical, and nothing's for sale or investment at this time. The bottom line is to always check with your advisors before making any kind of investment decision. All right, so for those of you joining us for the first time here at No Club USA, this is our mission statement. We educate and help people invest in and create payment streams backed by real estate without the traditional investment headaches. Quite simply, it's about more profit with less stress. So since some of you were new with us, this is the first time you've seen us talk about this concept. I'm going to use a case study from podcast 1. This is an actual note that I own. I'm going to briefly go over how this works. It's on a property in Georgia. The current market value is $149,000. It's a simple 3-2. And we're the bank on this property. So a little over a year ago, I bought this loan from another investor. The borrowers who live in the property owed $107,950. I purchased that debt at what we call buying at a discount. I bought it for $88,620. That entitles me to the $873 mortgage payment for the next 351 months, which was left on the loan. And that gives me a total return of $306,423, or an effective annual return of 11.4%. That's very simply how note investing for income works. You just become the bank and are entitled to collect the payments versus a traditional lender. So we do like to use visuals to show how this works. The orange here is a graphic representation of amortization table, how the loan is paid down by the borrower, how much they owe over time. At any time along the bottom, I can see how many months are left, and along the left-hand side, how much the borrower would owe. On day one, he owes $107,950. That's what he owes when I purchased the note. Now, I purchased the note, which is my blue remaining investment, for $88,620. So if on day one, the borrower decided to sell the property, refinance, or however he wanted to get out of the loan, I'd have an instant payday of $19,330, which would be a nice 21.8% return right off the bat. Now, this doesn't happen very often, but if you're here for episode 3, you'll remember that I went over a note that paid off in 6 weeks. So we do like to see that, but generally, what I'm told, generally these pay off over 7 to 10 years, and this was a higher interest rate. This was, I believe, 9.9%, 9%, something like that. So when interest rates go back down, maybe this person will refi. But anyway, in a strong position no matter what, and a lot of that is because of buying at a discount. All right, so let's look at the more likely scenario that he stays in the property for a while and wants to pay it off after 10 years. So he refis or sells the property. At that point, he's still going to owe $95,684, assuming that he's paid the minimum payment on schedule. My basis in the loan is still $81,589 because a little bit of the payment every month comes back and pays down the principal. So at closing, the title company is going to write me a check for $95,684, which will represent a return of my basis remaining, which is $81,589, plus a profit of $14,095. Well, on top of that, during the 10 years, I received $104,760 in monthly payments. So I've had all of my money returned to me and received an additional $118,855. So if you haven't seen this presentation before, just want to emphasize that we're not doing all this work ourselves. Just like you might have property management for your rentals, we have note management. We use a servicer who does all the work for us. Some of the things they do is they collect payments, they escrow taxes and insurance, they're licensed and compliant in every state. They handle the borrower's issues, they collect the payment, take out a small fee, and send that cash to me every month, or a check, mailbox or ACH deposit. The key is to outsource, and it only costs about $15 to $50 a month. Of course, without fail, anybody who sees a presentation like this asks, what if they stop paying on the note? And we went over that pretty in depth in episode 2, non-performing loans. Our guest has extensive knowledge and experience in dealing with these. And the bottom line is it's not a big deal. We have a pretty strong position. And if you'd like to see more about that, go ahead and check that podcast episode out, number 2 with Dr. Emily Thompson. And if you'd like to see any of our past podcasts, you can go to noteclubusa.com. Our podcast list is there. Episode 2 is the one on non-performing loans. But if you're really interested in what we're talking about, you can see a much longer presentation, covers 3 notes plus a lot of the different workout options. It's about 40 minutes long. You can just go to noteclubusa.com/CF, like cash flow, and that video is right there. And in episode 3, we talked about all sorts of tax advantage ways to invest, and I think that's a must-see podcast as well. Our guest was Derek Long from Quest Trust Company, and he shows how you can unlock the power of not only retirement accounts, but other tax advantaged accounts to earn tax-free or tax-deferred growth, and I think everybody found that to be a very interesting presentation. Okay, so one thing I'm asked when talking about notes, especially just buying performing notes for cash flow, is, okay, I've got a note, now I've started to buy a whole bunch of them, and eventually my entire stack of investable cash is used up. So what can I do with them then? Do I just have to hold on to the cash flow? What if I need money for an emergency, or I want to recapitalize my bank? How does that work? So we're going to touch on that briefly before we get to our guest today. Now, one thing I've always said about notes is just about anything you can do in real estate, you can do with notes. However, I think there's one advantage that we have with the paper side of the business is it's very liquid. Turning your note into cash in a variety of ways is actually fairly simple and can be a pretty quick way to get money if you absolutely need it. Probably the simplest way is to go ahead and sell the note to another buyer, another investor. There's several online marketplaces, brokers like me who facilitate transactions, plenty of places to buy and sell the note, and it's a fairly simple transaction. I've got a payment stream, the note, I'll go ahead and sell it to an investor. That investor writes me a check. They now receive the payment streams and I have a check. It's as simple as that. If you're here for podcast 2, then you'll remember that Dr. Emily Thompson took one of her notes and actually pledged it for a loan from an investor. So she used that as collateral for a loan from an investor. And in this case, the numbers are kind of small, but the bottom line is she invested $56,440 into debt worth $60,607. She was able to receive a loan from a private investor for $60,000. So she actually took in over $3,500 more than she spent. And then every month she collects $140 more than what she pays out to the lender. Now, this was kind of an extreme example. More likely, you're going to find somebody who's going to loan you money for 5 to 10 years versus the 351-month term. But we covered that on podcast 2, how that would work out as well. So she was paying off on the loan for the first 10 years and then was paying off a hypothetical bank later on. So that's another thing we do. It's also called hypothecation, and a very popular way to go ahead and recapitalize your bank. A lot of companies out there will loan against it, as well as large investors. And this is my favorite part of any presentation when I talk about liquidity and what you can do with notes once you own them. It's called the partial, which is one of the greatest wealth building strategies that nobody has ever heard of. And when I present it to folks for the first time, I normally have to go back and do it again so they can see does it really work like that. And this is also one of the cornerstones of Eddie Speed's Masterclass presentation that I actually have tickets to. And if you stay to the end of the program, I'll be able to give you some of those. All right, so think as a note as a pizza, and partials are like pizzas in that they can be sliced up and divvied up. So you've paid your $6, you get the whole pizza, and you have friends that you can sell the parts of the pizza off for $2 a piece. So in the end, you have nothing left as far as invested in the pizza, but you still have half of it left. Now that's exactly how a partial works. Just one caution here, I do mention this right now, as your wheels are probably starting to spin. A note is an asset, it's not a security. So when we talk about selling off partials, we're not talking about selling off parts of the note all at once. We only want to sell off one set of payment streams until that is paid off, and then we can sell off another after that. We don't want to have multiple ones out there. That's considered securitizing the asset, and that changes the game quite a bit. Can get you in a little hot water, but actually just selling off a chunk of payment stream to an investor one at a time, there's nothing wrong with that. So let me show you how that works. So we'll go back to the example I just showed you where the borrower owed $107,950 at 9%, and I bought the note for $88,620. So as I mentioned at that time, that allowed me the opportunity to collect 351 payments of $873 for an 11.4% return. And this is how the amortization table is graphically displayed. All right, so right now out there, there's billions upon billions of dollars in what we call scared money out there, invested in nothing, sitting on the sideline and looking for an opportunity to get 6 or 7% in something that's relatively low risk, secured by real estate or something else that gives it a high degree of security. So we can find scared money investors all day who are thrilled to get a 6 to 7% return on their money, especially if it's secured with real estate. So what I would do in this situation is I can sell the first 143 payments of this particular note to an investor for a total of $88,620. That works out to a 6% return. So basically I've asked the servicer to, instead of sending the mailbox money to me every month or ACH, it goes to the investor once I go ahead and collect that $88,620. They start to get the payments instead of me. Now, at this point, I have zero money in the deal. We are entitled to the 144th to the 351st payment, and we'll get a lump sum if the loan pays early. And this is a graphic representation. So for the next 143 payments, those all go to the investor. He's making 6% money on his $88,620. I'm not getting anything during that 143 months, but I have zero money in the deal, and I've set up a back end that'll pay from months 144 to 351. I'll leave that slide up there a minute so you can look at that. All right, so here's a different representation. I purchased the right to receive 351 payments of $873, and I decided to sell 143 of those payments, the first 143, to another investor for a total of $88,620, which happens to be what I have in there. The remaining 208 payments are on the back end, and the servicer is simply instructed to redirect those first 143 payments to the investor, and then it'll change back over to me. But remember, I have zero in the deal. He's paying $88,620. That's what I originally paid. His total return is going to be $124,839, which equates to a 6% return. But I still have a vested interest in the deal, obviously. I've got a pretty valuable back end here, so I'm going to make sure that I keep an eye on this note, make sure that it's performing, and we have mutual interest in making sure that it gets to the finish line. Plus, since there's also the built-in discount like we showed before, if it's paid off early, there's that chunk of change between what the borrower owes and what I would be receiving that is still something that I would get. Okay, so here's our graphical representation again. As you can see, I've essentially sold off a slice of my entitlement. The whole pie is what the borrower owes overall. The slice is what I've sold off. And as you can see, there's a gap always between the top of the blue slice, which is what the investor is owed on a cash out or refi event, and what my entitlement is, which is the top line on the orange arc. So the investor knows we have a huge vested interest in the performance of the note because I'm entitled to some money whenever this thing is paid off or refied. So I'll still be there to help handle any issues that might come up and require a workout. And the value of the asset at $149,000 still makes this an extremely low risk investment for both parties. So just to be clear, on that slice, as you can see, it moves down to the 143 mark fairly quickly. The difference between the top of the blue slice and the top of the orange arc, as it were, is what I am owed at any time if the property is refinanced or sold. So even though I have $0 in the deal, when this particular borrower decides to refi or sell, I'm going to get a payday, and it gets larger over time. And eventually I'll own the entire note back and still have paid zero in it. So very cool concept. All right, so just to put some numbers to it, once again, $0 in the deal. Here's some examples of how this could play out. Let's say the borrower stays in the home for 351 months. No refi, pays as agreed. It does happen. So the investor who I sold the partial to will collect his or her 143 payments and is fully paid off after that 143 months. Starting in month 144, I start collecting over 17 years worth of payments to a total of $181,584. And what did I have in it? Zero. So let's look at a more typical example. You've got $0 in the deal, and the borrower sells the home or refinances in 5 years. So our investor who bought the partial collects his or her first 60 payments for a total of $52,380, and then we'll receive a lump sum of $60,905 back in a lump sum. That's the difference between the top of the blue arc and the zero line. So that's what's still remaining for the basis in their loan. Now, as the overall note investor, myself, you receive the difference between the underlying loan payoff and what is owed to the investor. So at the 5-year point, the borrower is paying off $103,559. I've paid my investor the $60.95. There's a $42,654 spread that goes into my pocket. And once again, I had $0 in the deal. So we have a saying that it's your chalk, your chalkboard. You can draw this up with your investor however it suits the two of you. And let's say that you wanted to pocket, in this case, $10,000 more up front than you invested. Well, you're just going to sell more payments. With this particular note, if you just sold 2 years more worth of payments than you did before, you'd pocket $10,000 more than you paid for the note. You'd still keep 184 payments on the back side, plus a payday if and when the home sells or is refinanced. So graphically, it looks like this. Rather than selling we sold 143 payments. Now we sold 176 payments for $98,620. The investor's still getting a 6% return. It just takes a little longer over time for him to get his money back. And I pocketed $10,000 more than I spent on the note. How many of y'all like to do that? I'd love to do that every day of the week. Let's go ahead and cut it a different way. Let's say that you want to retire in 10 years and start your payment streams then. So we just sell the first 10 years worth of payments and we start collecting a month 121. So in this case, the investor's payment would be $78,650 for 10 years worth of payments at 6%. Now all you have out of pocket is $9,970. Now you're keeping 231 payments on the backside, plus a bigger payday if and when the home sells or is refinanced. And this is what it looks like. All right, so one last thing, and this ties it all together in a pretty powerful way. What if you could put a few of these in your kids' or grandkids' Roth IRA or Coverdale, or even your Roth account? So follow with me on this. So we find a good performing note like this that sells at a discount, $88,620. Now, we have an investor from our pool who'll buy 142 payments up front, and will pay the $88,520, so they're $100 short. Your child's Roth or Coverdale comes up with the remaining $100. Now, the IRS wants skin in the game. You execute the note equivalent of a simultaneous close, but actually much simpler. Now, at closing, the investor and the Roth Coverdale funds are submitted at closing. So the investor comes to the table with $88,520, and you also bring in the $100 from the Roth or Coverdale to fund the deal. Note ownership is transferred to the Roth or Coverdale with the first 142 payments assigned to the investor through the servicer. So this is what it looks like. The investor's getting paid. The kids, or the Roth's portion, is on the back end. I think it's an amazing, amazing concept. Might be a little confusing right now, but I'm just trying to show you the power of partials, which I think when you understand it, you'll wish you'd gotten into notes 20 years ago. Now I could talk about partials all day, and my guest is waiting in the studio, so I want to get this wrapped up. But if this partials concept, especially for generational wealth, has intrigued you, go to Noteschool's YouTube channel, search for this video right here with Martha Speed, or anything with Martha Speed. She's perfected the art of creating generational wealth for her family using partials, and I think you'll find it really, really interesting. Better yet, you can go ahead and learn from Eddie Speed in real time. They're having a masterclass. The next one, as of this taping, is March 29th from 11 a.m. to 1 p.m. Central Daylight Time. They've been gracious enough to grant me some limited seats for people who would like to learn more about not only partials, but notes in general, especially if you're a real estate agent, burnout landlord, just want to learn to start investing, whatever your interest is in what we do. It's a 2-hour class that's going to be pretty information packed, absolutely free when you get tickets from me. Stay till the end of today's presentation after I talk with Joe Varnador from Noteschool. And I think you'll be glad you did, and I'll have those tickets ready for you right after the podcast is over today. So I'm going to run us out of the classroom, run us over to the studio, short commercial break, and we will get started in just a minute. Thanks for being with us, and I think you're really going to enjoy our guest today. Hey, it's Tom Force from No Club USA, and today I'm in the beautiful paradise of Punta Cana on the eastern tip of the Dominican Republic. Didn't always used to be like this. Back in the late 60s, some investors bought about 30 square miles of jungle and turned this into a paradise over time. It included Julio Iglesias and Oscar de la Renta have invested during that time. But it used to be called Drunken Point, and they named it Punta Cana, which is probably a much better marketing move. But the Cana refers to that palm tree behind me. As you can see, I think that that base there can be a parallel for our investments. Looks like you can push that thing over. The water continually erodes at the base of that tree, but those roots have gone deep and wide, and they're probably down there a long way. And so you can't knock that tree over, even though inflation, as we would call it, is wearing away at the investment. I think there's a pretty cool parallel there. So anyway, I think we could say that the original investors here, their ROI was, we'll call it pretty good. Don't need to get a calculator out. But how's your ROI going these days? Scared money, sitting on the sidelines, losing to inflation, stock market afraid to open up the 401k statement, rental real estate has its ups and downs. The pro forma doesn't always match the cash going in. I've got an Airbnb as well, and last time I was on vacation, my guest drove me crazy, ruined a couple of days of my vacation. If you have an Airbnb business, you know what I'm talking about. What I'm not worried about is the cash flow from my notes. I've got a servicer taking care of those. I don't get phone calls about broken toilets, tenants, or any of those other headaches. And so I can relax and enjoy the fruits of my labor and have that cash flow coming in, and I'm not having to put out fires. So anyway, I'll make it brief. I'm gonna let you go. As you can see, as my unpaid actors walk behind me, you can see how deep those roots go. Let's work on getting your roots deep and start looking at note investing. Go to my website. We're going to launch a podcast in January and hope to have you guys partake in that. Or you can go to my website. We can have a consultation or just ask me a question. I love talking about it. Most people don't know about Punta Cana. Most people don't know about note investing, but they're going to fall in love with both. So come see NoClubUSA.com.
and come to Punta Cana. You'll be happy you did both. Have a good one.
All right, we're back. Episode 4 of the No Club USA Cash Flow podcast. If you've been with us for the previous 3 episodes, we've kind of had a building block approach to notes. And we just finished a classroom session on what you can do with your notes when you own them. But there's a lot that goes on before you go and actually have the confidence to buy a note for whatever reason you want to do that, whether it's for retirement, to acquire a property, or whatever you would like to do with it. So in this part of the series, episode 4, we've built up to the point where I think those of you who are with me want to learn more about notes and why now. And we're kind of in a unique point in history with the markets being all over the place, real estate being turned upside down on its head, real estate agents not knowing what to do to supplement or even make an income. I thought it'd be the perfect time to bring on the Director of Student Engagement for Noteschool, my buddy Joe Varnador. How are you doing, Joe?
Hey, very good, Tom. Thanks so much for having me with you guys today, and I look forward to our conversation.
Well, Joe, you've been instrumental in getting me into the note space. Why don't you tell folks a little bit about your background in notes, how life is in Okeechobee, Florida, where you're from?
Yeah, for sure.
Give everybody a little 30,000-foot view on how you got involved in notes.
Well, yeah. So actually, it goes way back, Tom. So I bought my first house at the ripe old age of 19, and it was an ugly house, and I started with fix and flips. That was in 1979. I think
it was way back, my friend.
79, yeah. And did that for a number of years, and I discovered notes in it was about 1990, and never looked back. I mean, yes, we still do some rehabs and some wholesales and things like that, but it changed my whole perspective to know that you could be the bank, right? You could, you didn't have to deal with everything that went along with owning the property, whether it's landlording or whatever it is you want to do. And so it's been an amazing ride over the years, and been able to accumulate, many different notes and so on in the portfolio. And so that's been great. And then I've been working with Noteschool for a little over 10 years now. So that's been a lot of fun. I get to meet people like you, Tom, that I'd have never met, right?
Absolutely, Joe. Absolutely.
And Okeechobee is a small town. It's 45,000 people in the entire county. So
I knew it from the lake. I knew where the lake was. I didn't know there was a town there too.
Yeah. Yes. It's the only city in the county. So that's right. So It's a great place to live, and we've raised our family here and about to be grandparents, just like you're about to be a grandparent.
I heard that. Right? Yeah, we have our third one on the way, and
third one.
Yep. Got 2. In fact, I mentioned them in podcast 3 when we talked about what our why is.
That's right.
And I talked about legacy planning. Good segue there. But
that's exactly right.
Yeah, exactly. So notes were definitely an attraction, not only for current income, but as I mentioned before, my wife and I have been in a lot of real estate ventures, and I don't have what it takes to be a landlord. And I don't think a lot of people like the grind. I mean, we were playing poker the other night with some of the folks in the real estate business, and they're ready to get out of the grind. My younger son has a podcast. It's called the Only Real Estate Podcast Worth Listening To. And I was a guest on there, and one of his buddies saying he's ready to get rid of the grind. And that's what it is. It's a grind. And he's successful, but he has lots of properties. So I see notes not only from my perspective, where I went and just wanted to create my retirement with a chunk of cash that was sitting around and pretty much stress-free. But 2 other target audiences. One would be the burnout landlord, which this guy is, as well as the real estate agent that doesn't really know what to do these days. And from what I understand, Noteschool is really seeing an interest from people like this too. And you're an instructor at Noteschool, so I thought maybe that'd be a great time to have you talk about the wheres and whys, why people are coming to Noteschool these days.
Tom, what you're saying is exactly right. And we address, the first piece of that is the real estate agent, which, the world has totally changed. If you started as an agent, over the past couple of years, 3 years, well, interest rates were low, property prices were going up. You didn't have to be a great real estate salesperson to nail it, right?
Not at all.
You put it on the market and you get 10 offers and above list, and boom, you go with the best buyer. And now,
Yep.
well, we've looked at that piece of affordability. And so great place to, and we're seeing more and more and more realtors that are coming into the, into Note School for training, simply because they want to learn something else to do that, that has to do with more of the paper, not the property.
Right.
And then the other part of that is like you said, it's the creative financing part of that. So, Tom, at Note School, we teach three different legs of training. Number one is performing loans, and I know you and I've had the conversation. You've talked about partials, and you've talked about hypothecations, pledging
Right.
a loan for cash flow. You've talked about those things, and that's the real deal, right? That gives you the ability, when you're doing partials, to build your own bank, right?
Absolutely.
You buy a loan, you sell enough of it to get your investment back, and maybe put a little money in your pocket, and then you sell a partial, you get that money back, and you go put it into another one, and you're operating your own little bank. So,
and it's when you put it in the calculator, it actually breaks the calculator. It says error for your rate of return, which means it's enough.
Calculate a yield when you don't have any money invested in anymore, right?
How do you do that? And I tell people, there's nothing you can do in real estate that you can't do with notes for the most part. But this is something you can do in notes that I don't know of a way to do in real estate.
Right.
It's just, and it's a very liquid business. Paper is very transferable. If you need money in a hurry, just within our Note School ecosphere, the people I know through our private groups and what have you, I know somebody will want to buy my note at a fair price if I get in a bind,
Exactly.
regardless of partial or anything like that. So very liquid. And as you know, as we've talked, that was my interest in getting into notes. But I discovered so much more. And it was funny because I was trying to teach a note class to my son's real estate agency with the purpose of getting them to understand seller financing. But you got to do a building block approach, kind of like we've done with the podcast. And none of them had ever heard about notes before. So that's why I decided, well, we'll put this podcast together and raise the education piece a little bit. So what are you seeing with the real estate agents? What are their specific interests, their questions? It sounds like a lot of high level folks are wanting to come to.
Well, there are a lot of high level folks that have been doing the business many years, and they've accumulated some wealth, but then it's like, okay, where do I put that wealth? And a lot of them have been putting it into rentals, and Tom, some people love their rentals, and that's okay. That is just fine. Talked to a guy the other day. Well, I will say this: he manages 675 rentals, right? And he just joined he just came to a Note School, a 3-day class, and is continuing in education with Note School. So there is a grind to that, right? And that is, we don't have to get into all, everything that entails, but there is. And what we're teaching, what the big part of that is our realtors that are getting in that have, well, they're burnout landlords, right? We kind of coined that, not burned, but burnt out landlords. And these are, folks that realize they have these properties, they can sell them. And even if they owe money on them, they can sell them with a subject to wrap loan, and they can make a whole lot more money that they put in their pocket, right? It's not, you're not having to pay taxes and insurance and getting those invoices, those surprise invoices for an AC system or a water heater or whatever that you see, and it's net income. And
how does that work? So talk to me. You and I speak the same language, but for somebody who's what's a subject to and what's a wrap, and how does that benefit the seller and people involved?
So I've got Jim Tiernan. I can mention Jim, and he we were looking at a deal that he did the other day, and so he's in Denver. He's got some rentals in Illinois. Okay. Right. So he bought the one rental that we were talking about. He had bought that in 2013, and he paid $125,000 down on it. He did what most people do. He went out and got a bank loan. He paid $25,000 down on it, so he had a $100,000 loan at 4% with Chase.
Sure.
So he's paid on it for 10 years, and now there's 20 years left on this loan. And he decides, and he was making, his rent was $1,575 a month.
Okay.
His payment on his loan, right, principal and interest, was $500 a month. But you would say, okay, well, there's $1,000 a month between that. But he was netting at the end of the day, $440 a month.
Right. All the expenses, sure.
Yeah, net. That was, and that's subject to change as well. So he decides, I'm going to sell it and leave that underlying loan in place. So he finds a buyer for it, and we call them a penalty box buyer. And there's are just missed folks that are self-employed. They're 30% of the folks out there. It
includes a lot of real estate agents
are self-employed, right? Just like a real estate agent
fall in that category. Yeah.
Right. And, banks just, they don't like the fluctuation of income for a self-employed person.
Well, sure.
You may make $1,000 or no bucks this month, and next month you make $50,000. Right. So anyway, Jim, offers it. He sells it for $175,000 with $20,000 down. And his underlying lien is that he owes $82,000 on this, and has got 20 years left on his loan, and his payment's $500 a month. But then when he resells it, he does it at 9%, and for 30 years. So he's making, for the next 20 years, he's making $900 a month on it, net. He sold the house, so he's making $900 a month on it. And he's receiving because he's got the underlying loan, but he doesn't have to worry about the taxes or the insurance or the maintenance, the upkeep, all of those things. And when that underlying lien pays off in 20 years, he's receiving the entire payment of $1,500 for the next 10 years. So he just wrapped a larger, higher interest rate loan around a lower interest rate loan.
It almost sounds illegal, Joe. Is it all legal?
Well, and we've got so many people, our friends Lois and Cindy. Yeah, we've got so many people that have been in rentals, and they've done that. I did that 85 times 6 years ago when we were getting out of the family rentals that we owned, right? So that is certainly a way to get out of it. If you own them free and clear, well, it's even a simpler process there. But here's what we know, Tom. The reason that we saw prices do this was because interest rates did that, right? They were lowest in history, and people are kind of freaked out now that interest rates are in the sevens. Yep. And we did I did some research on that. So, but over the last 50 years, the average interest rate over the last 50 years has been 7.77.
Right.
So this is more typical than that anomaly where we had 2 years of 3% rates.
Joe, do you recall what the rate was when you bought that house in 79?
It was 18%.
You got me beat. My first house in 86 was 14.5.
Yeah.
And you know what? We didn't think twice about it. It was what it was, And I think, eventually we're going to get that kind of memory here, in our markets. Like, this is the new normal, if that's what it's going to be,
Well, and I remember we were looking at this morning some things. And so I remember in 1990 is where it kind of dropped below 10%. And I remember thinking in the late 80s, oh my gosh, if it ever got back down to single digits, it would be amazing.
Yeah.
And then comparing the last time it was in 2012, rates were 3.88, right? Okay. And so that's the closest we've been. But remember, we were just coming out of a recession, and what did the feds do? Right. They had lowered the threshold for the rates, and which is what happened in 2021 and 2022.
Yeah, exactly.
So it is affordability for folks, and it just makes sense that we can do this because we understand how to do it. And that's what we teach at Note School.
Right. Exactly. Yeah. Well, I have a quote that I used in the last podcast is risk comes from not knowing what you're doing. And you guys make sure people know what they're doing.
Well,
to get me off the fence to invest a lot of money just in performing notes, that took a lot. And I got the confidence to know what I was doing. And so that was very impressive.
Well, you've got to decide that you've got to make that conscious decision that you're going to get out there and you're going to do something and you're going to move forward. You can do nothing and that's what you end up with, or you take that step and you do it. And we see people do that every day, that get out there, they're swinging the bat, they're making deals, they're looking for deals. And, so this is the perfect time. This is the perfect time for creative financing. Tom, we talk about in Note School, we talk about the mortgage credit availability index.
Mm-hmm.
And so, we know the pandemic started in March of 2020. And then this credit availability index was, way up at about 185 points, right? Now that's down around 100 points. And what that means is that if 1,000 people could have gotten a loan in January of 2020, about somewhere between 600 and 700 of those could get a loan today because of the tightening of that. And what we're seeing here at this point is what's gone on over the past week, right? We know things are already subject to change, right?
Another crazy Wednesday.
Is that
you never know what to expect when Powell talks?
Yeah, and we're seeing that it's just tightening the screws on the availability of credit. And, the perfect person, and I just was reading something. So typically over the last few years, that gold standard for kind of getting a bank loan was you needed about a 740, to get a really decent rate, you needed a 740. And you needed 20% down, and your debt to income ratio had to be 23 with a high on the house payment, your new house payment, principal and interest, taxes and insurance. And then the top end, which includes all of your revolving and installment debt, was 740. That's what that score was. Now it's jumped up to 780.
Yep.
And with the affordability and with, people have, good credit, they have money to put down, but what we're looking at and what we're seeing is those 30 to 40% of the people out there that can't go and get a conventional loan.
Right.
It's not that they're great people. It's just the system is not set up for those people. And therein lies a huge opportunity for folks in the note business that understand what we do.
So they say there's the bigger the problem, the more money to be made. And that's where we're stepping in and doing that. So if I hear you, we're helping people like the burnout landlord. We're opening up avenues of people to come in and actually buy from them that might not actually be able to do so to begin with. So we're basically playing matchmaker. We're able to go in and help them with seller financing, and then we're bringing along buyers that would never be able to just contact them off the MLS and say, "Hey, here we go." So,
well, Tom, one of the stats here that we know is most people think that hedge funds are the largest owners of single family rentals. It's just not so.
Right.
There's 23 million single family rentals in the U.S. Almost 17 million of those are owned by mom and pop landlords, right?
We're self-managing at the same time.
And they're self-managing. And so 75% are self-managing. And then you've got, the thing that's really strikes me is you've got almost 11 million of those that are free and clear, right? Those are free and clear properties. They've owned them a while. The average age of the landlord is somewhere between 65 and 85. And they're just ready for something different. They bought those rentals thinking they would have total passive income, and it didn't work out like that. And now when they're ready to sell them after they've owned them 30 years, well, the IRS wants their their depreciation back. You got to
Mhm.
recapture that, and then you got to pay capital gains on that. So
Yeah, because I was going to ask you, why don't they just list it and sell it? But it gets a little more complicated than that, right? So
well, you know,
how does installment sales work with that? How does that? Because
well,
that to me has been one of the things that I tell real estate agents is, have you ever made a burnout landlord or an expired a tax offer? So how does that work?
So, the IRS gives you, when you own rental property, you get to depreciate the value over 27 and a half years. And then, if you've owned it for 30 years and you've depreciated it all the way, then every dime that you depreciated, you have to recapture. Right.
Right.
And that's a 25% bill. Right.
Up,
And
ordinary
then
income up to 25. Yeah.
up to
Ordinary rate.
25. And then on
Yep.
the capital gain side of that, it could be 0 to 20%, depending on, your income thresholds, right?
Right.
So you
And
could write
probably
a
going to
check.
go up.
Yeah, you could write a check for, many, many, many thousands of dollars. Well, the thing that most people don't realize is that if you sell on an installment sale, then you only have to pay the gain as you receive the gain. You only have to pay
Okay.
the capital gains as you receive it. So I'm not saying you don't pay capital gains.
Right.
You just get to take it over time. If it's a 30-year loan, then you take it over 30 years.
Sure. That makes a lot of sense. So
So,
So
that's a
when you're receiving
huge
those
difference.
payments, you'll be getting some of it will be interest at ordinary income rates.
Yeah,
Some will be return to your basis, and some will be subject to long-term capital gains. But
right.
we're not tax professionals. But I think this year, if the income is less than about 80,800 as a married couple, then
Actually, it went up, Tom. It's
did it?
$89,000 in
Oh, nice. I'm using
2023.
it 2022,
Yeah, it went
2022
up.
rates.
Yeah, that
Fantastic.
would be the 22 rates were 80,800, and it's $89,625 or something like that, if I, to be exact. But yeah, and so the question is, well, that's great if you're working with these landlords, but how do you make money with that? Well,
Right.
again, and then the other challenge for somebody that's owned properties for a long time, Tom, is so they do, if they sell it for cash, they take care of their taxes, they do all of that, and then they get a couple of $100,000 or $300,000 left over. Where are they going to put that in today's marketplace?
Scary.
And
Yep.
that's why buying from them on terms with seller financing it, they are financing something they've paid for over years. Now it can pay them back and give them long-term cash flow. And they're familiar with the asset, right? They're
Right.
familiar with that house. We simply, get it, and then we can, if we're kind of the middleman, we resell it to one of these penalty box buyers at a little higher interest rate than we're paying the sellers, and we can profit greatly with cash today and cash flow for a long time.
And if you're doing that properly, Joe, you're not really the middleman. You're not collecting checks and writing checks. You're using a servicer, right? So
All banks use third-party servicers
Yep.
now that are licensed and compliant in all 50 states. We have a list of servicers that are, like compliant. You're not handling any of that, right? The check goes to the servicer. The servicer then sends out the money. If there's an underlying lien to your seller, they're sending that check out. They're sending the difference to you. They're collecting the taxes and insurance, and they're throwing those into an escrow account to pay those
Yep.
to the proper payees when they're due.
So Joe, I want to go over a couple of things you mentioned there. And I think our buddy Eddie Speed often says you can play at the JV level or you can play at the professional level.
Yeah.
And I think this is where Noteschool really differentiates itself, because somebody can watch this podcast and go out and attempt to do what you're talking about and get themselves in a lot of trouble if they don't know what they're doing. Whereas you guys teach certain things like that penalty box buyer. We're not taking the first person who fogs a mirror off of Craigslist. We're they're buying as an individual. We're going to put them through some Dodd-Frank compliant qualifying and things like that. So
Tom, the key to doing that is the proper paperwork. You can't just go out and cowboy it up, right? You need to use the proper paperwork, and then you need to make sure that the loan that you go by make sure the loan is SAFE Act compliant, that the borrower has the ability to repay.
Right.
And that's big because, back in what led up to the Great Recession was predatory lending, and we're not doing predatory lending.
Right. So what could happen if I just took somebody and just they said they could pay and they didn't and they got into trouble? What could happen to me?
Well, basically, what they can do when you file the foreclosure, lawsuit to take your property back because they're not paying it, then they're going to get a lawyer, and that lawyer is going to say, well, where's the file that said you had to make sure Dodd-Frank Safe Act says you have to have the ability to repay, but you never looked at their credit, you never looked at their income, you never verified their income, and you never checked on their debt to income ratio. Right? Got to meet those criteria, and if that doesn't work, the judge is basically going to say, you lose. Now you get your house back. Right. But every dime they've paid you over the years, their down payment, their monthly payment, you got to pay them back for that. And
you got to come up with the cash. Yeah.
And you got to come up with the cash. And then you've got to pay their attorney's fees as well.
Right.
What's your attorney's fees?
Absolutely. And, I'm on social media a bit, and I see folks in other note forums on Facebook or whatever. And I'm like, sometimes I cringe at what I'm hearing. So that's one thing that I want to mention. And not only do you guys teach this stuff, but you're a conduit to all the resources we need. Yeah. I was going through the Noteschool vendor list today because, I wanted to track down an attorney in a certain state where I'm having trouble with a particular lender. And it's right there, whether it's property preservation or the other things that you go through when notes go south, we have a one-stop shop. So, and that's something I really appreciate as well.
Well, what we say there is, I've been doing it for 32 years. Eddie's been doing it for 42 years. And what we do in that membership in the Note School pieces that Eddie has basically opened his Rolodex. I mean, some people are too young to remember what a Rolodex is, Tom.
Yeah.
But
We're dating ourselves, Joe.
And we've got vendors, and that's the thing. This is a scalable business. This is a scalable business where you can make way more than full-time income on a real part-time basis. And that's what's attractive. And, when you're dealing with the paper, you're not dealing with the property, right? You're you're the lender, basically, right? Or you are the lender, not basically. That's just what you are.
Right. When my toilet backs up, I don't call Wells Fargo. I wouldn't want to anyway.
You may call them, but I don't think they're
going to be like, what? So, yeah. And my story, like a year and a half, almost 2 years ago, I didn't know this existed, know, and when I teach it to realtors, most of them don't know it existed. I know Eddie went to a group down at the beginning of February, was teaching some of the top income realtors, and they ate it all up, right?
They did. And we just got through with our Tuesday deal lab, and, we had, we had some great case studies, some great deals that people were bringing in, and we've got a bunch of new Note School folks that they are high net worth realtors that have been really successful.
Right.
And now it's time, they're saying it's time for us to go do something a little bit differently and slow down a little bit. The grind gets you, when you're a realtor, Tom, it's like being a wholesaler in the business, right? You get a house under contract and you resell, and you flip the contract and you make some money.
Right.
Or if you're doing a buy, fix, and sell, you're a rehabber, you're making transactional money.
Yes. Mm-hmm.
But the thing about notes is, and what we teach you to do is you can make the same money today, but then you make cash flow over the next 20 or 30 years. And that's amazing.
It is. And also when you get to my age, I'm just a little older than you, Joe, not much, but you get up to in your 60s, you start thinking about legacy planning. And I know that's a big part of what Eddie teaches and what you teach. Absolutely. In that, what do I want to leave behind for my family? Do I want them to try to manage rentals? Maybe they're not into it. I know countless stories of kids, who are living in the basement, they can barely make money in society. Are they going to manage the family's rentals when they're gone? Or are they just going to make a mess? Whereas these notes, they'll continue to pay even if I'm not here. And if you got it structured properly, it's the perfect vehicle. And I had Derek Long from Quest on last podcast, and how we can use Roth IRAs and Coverdales and HSAs to structure everything. It was a great episode. So
Well, Tom, there are so many layers to this, and I've spoken to, thousands of people over the years about this. And, you go into a group of 200 or 300 people and say, "Hey, I'm in the note business." And they go, and then you say, "Well, how many of you have ever bought a house where the seller financed it?" And 2 or 3 will raise their hand. Well, how many of you have ever sold a house and financed that for your buyer? And two
Right.
or three will raise their hand and say, "Well, how many of you have ever done a creative finance deal?" And they don't know. Or you could say, "How many of you have ever bought a non-performing loan?" And then they look at you like you have 12 heads, Tom.
Absolutely. But it doesn't take long if you're speaking to the right group for the light to go on. It's not like they have to take a full weekend webinar or seminar from a $10,000 guru to maybe get them to think maybe this could happen. It doesn't take long once you see how it works. And I think part of the problem is it's not terribly exciting on the outside. HGTV is not going to have a series on notes. Here's Chip and Joanne at the closing table, and it's 3 minutes later, we're done, so.
Well, that, and I always was a fan of Flip or Flop, right?
Yeah.
And Torek, and Torek always, you remember this, he always comes on at the end of that show. "Well, if we flip this house,
Right.
we stand to make $82,000 on it. Time to find another house to flip.
Time to go out and find another flip." But mentioning that, Joe, we've got an avalanche of notes out there and coming our way, right?
We do.
Yeah. There's something for everybody.
Yeah, there's plenty of notes. There's I think in 2021, we haven't gotten the 22 stats yet, but they'll be out in about another month. But there was about $30 billion that we can track in seller finance notes done in 2021. It was definitely going to be more in 2022 and 2023 because of the conditions, right? The tightening of credit. It's going to be a whole lot more than that. So there's plenty of room in this business, and it's a business that if you don't, that people don't know about, right? Everybody watches, Chip and Joanna and Ben and Aaron from, Laurel, Mississippi and all that.
Yep.
But like you said, there's nothing out here on this. And this is a pretty exciting business with a lot of layers to it, right?
When you peel back the onion and understand what's going on, I mean, to get me this excited where I'm actually doing my own podcast. You told me 2 years ago, I was like, really? No, I don't think so. I'm just going to kind of sail off into the sunset in retirement. So, but it's a whole different retirement now, Joe. I joke that, my wife and I love to cruise, and we could go on a 3-month cruise and I'd come back and I don't have to worry about my properties. Just check in with the servicer once a month, make sure that check's at the mailbox.
And if it's not, then you don't even have to send out the late
exactly
notice, Tom. You don't have to worry about adding the late fee.
Nope.
It's a different mindset, and it's a different world for people. And if you're looking at it, we see so many people, Tom, like yourself, who didn't know about this. You wanted to be in real estate, right? We hear this over and over and over.
I wanted the cash flow. Didn't necessarily want to be in real estate, but what else was I going to do?
What else were you going to do?
Right.
You could flip a house, and then that's so competitive. You can do a rehab, and God, that's a lot of work. Or you can be a landlord. And that's the only way that, if only properties, that's the only way you can get cash flows to be a landlord. But then you discover this, and there ain't no turning back, right?
Nope. I don't have to go break my back looking for flips and doing work or anything. I can sit here on my computer, do all my due diligence, which you guys are experts at teaching, what the things are that we look for. And there's a lot of, I don't want to say garbage notes out there, but there are some that, don't have the right qualities to make it something I'd be interested in. You've taught me how to look for the right things. And it all boils down, Joe, to, what's the worst that could happen? And if you know how to mitigate all that, and you guys teach that and have the resources to help with that, then
it's understanding that, Tom, and knowing, what you really want to know pretty quickly is it a good deal? Is it a great deal? Or is it a waste of time? And you want to get through that. And then when we're buying a note, we've got ourselves, remember, we're buying it at a discount, right? So whatever it's worth, we're in it at, maybe 60, 70, maybe 75% of the value of the property. So if it goes south, we've got plenty of cushion there to work ourselves out of it.
Exactly.
That's pretty cool.
Plus, there's a nice payday. I had mentioned in, I think, episode 3 about a land note I bought in North Carolina at a discount. And
I remember that.
$32,000 loan. I bought it for 27 and change, and it closed 6 weeks later. The guy sold it, and I made, $4,500 in 6 weeks. You can't, you can do some stuff like that in real estate, but it just, there's no stress with that. No realtors involved, anything like that. So those don't happen all the time, but the possibility is there. But buying at a discount is key, and sometimes you have to show it to people a couple of times, just like the partials. But the smart folks get it. So
yeah.
Joe, I could talk to you for an hour and a half.
I could too. Yeah.
So what I want to do here is, I've worked with Eddie and I've worked with you guys, and you guys have been very generous to allow my audience some limited seats to the masterclass. It's going to be an ongoing series that you guys have. I think the next one's March 29th. And if anybody's interested in the masterclass, stay after this episode. I've got a way you can contact me for some limited seats. If you can't make this one, we'll do the next one, but you can also get the recording. But beyond that, Joe, I think that's like a 2-hour masterclass. If you want to touch on what's in that, and then what's the progression to becoming a student like me? What happens?
Well, so basically, it starts with that 2-hour masterclass, right?
Okay.
You're going to take that's going to be the 30,000 foot view, the 35,000 foot view. Right?
A lot of the stuff that we've talked about, but it's just Eddie's going to teach a bunch of it, and that
Eddie's going to come in and he's going to give you that, and then if you decide that this really sounds like something I want to learn more about, then we have a 3-day class, and we do a 3-day class about once a month. Just got through with one on Sunday. And
Joe, you're the primary instructor in that, right?
I teach a lot of that 3-day class, about 80% of it. And we break it down. We break down all 3, legs of what we teach, right? Okay. Creative financing, buying notes and doing partials and pledges and all of that. And then, what are the opportunities out there in buying notes that aren't performing, right? And by the way, the answer to that question is why you would buy a non-performing loan. It's because of price, right? There's a one-word answer to that. And so we break that down into bite-sized nuggets. And, you come to a 3-day class, and then, you may make a decision that you want to take a longer term training situation with Noteschool, and we do provide that as well. So,
that's virtual, right? That 3-day class is virtual.
Yeah, we do. It's a virtual 3-day class. We hope to do some live classes, but everybody wants to go to a virtual, right?
One of the good things, I guess, that came from COVID, because you guys had to pivot pretty quickly, didn't you?
We did. The last live class we did was the end of February of 2020. We were all in San Francisco,
right? And
they were starting to shut down. The next class we did 2 weeks later was virtual, and so we've been virtual since middle of March. Well, two years now, right? Going into the 3rd year. And it's been great. We didn't know that we could do it as well as we figured out how to do it and still have that same engagement and that same, lean in. And so we've done that, and it's good. I would love to do some live classes again, a few a year, but we'll see how that goes.
Well, and the great thing about being part of the Noteschool family, Joe, is that we get to see you guys, maybe every quarter or so. There's always an event going on, whether it's Note Expo or the summit for the
summit,
coming up in May. We get together fairly regularly. Plus, I found that I get together with other students on the road. I had a layover in Oklahoma City and had dinner with Emily and her husband. And I think that's what's cool, Joe, is this is kind of a small community.
It is.
Everybody's in real estate. Everybody's a flipper. Everybody's a wholesaler, blah, blah, blah. Not a lot of people understand notes at the level that we do. Right. When you come through Noteschool, we're kind of a family. We've had people partner together on notes and just like right here. I talked to you yesterday about joining the podcast, and boom, what time do you need me?
Yeah, exactly.
The camaraderie, I think, is what sets us apart too, and I want to tell you how much I appreciate that.
And I don't want to get all corny and on all of that, but you're right. That ecosystem that we have inside, we've got some. You've had several on your podcast, and you'll have many more as you start to build that. But a lot of folks that are really engaged. We have a lot of fun, but we can be very serious about the business, and it's a give back thing, and it's cool to have. You may find a deal in Oklahoma City, or you may find a deal in Birmingham or Tampa or Okeechobee, right?
Very well could. And talk about corny, there is a saying that says you're in business for yourself but not by yourself.
That's right.
And I've looked at a lot of them, But to be honest, Joe, and I think anybody who's on the inside here at Note School would say, yeah, you're not by yourself here. I mean, with all the different calls that we have every week, I mean, you and I just got off of one recently. So
Right. Yeah. Just a little
we
while
bring
ago.
our deals to the table, and Eddie will sit there and he'll give his honest opinion. And sometimes you may be barking up the wrong tree, and he'll spank it and say, no, you don't need to be doing that. You know,
right.
so I
Well,
think that's where the greatest learning comes from.
I will say this, my friend Eddie is the most strategic thinker that I've ever met as far as putting a deal together that has the likelihood of getting accepted by the seller. Not bull, BS stuff, but really making it happen. And then understanding one of the biggest things, Tom, that I think we clear up a lot is most people are afraid to talk to a seller, right?
Right.
What do I say? How do I get them to do this? And it's really, the process is just, having a conversation. Find out what your pain is. You don't jump on the phone and say, Tom, I want to buy your house. I'm going to give you $70,000 for your 100,000, whatever it is. No, it's having a thoughtful, meaningful conversation. And
it's finding out what their pain point is. And if you only have, one bottle of medicine in your toolkit, and that's not what they're sick with, then you're out of luck. But when you know about notes and subject to and wraps and how to help them out of a lot of different illnesses they might have, then you're much more likely to get the deal. And you don't need to be the expert right off the bat. That's what I tell the realtors I work with. Have the conversation, say, hey, would you be open to having a conversation about maybe selling on terms? We might be able to get you the price you're looking for.
Well, those that are only in real estate, that are only doing one piece of it, right? One piece of it. I just hate to say it, but you're probably not going to survive into the new world that we're coming into.
Exactly.
You have to be. Yeah, sure. There is always going to be someone that wants to sell cash, and they want to, they'll take a discount and they'll sell it quickly. But then you've got others that are like, well, I either can't take a discount because I owe too much, right? I don't have enough equity, or I'm just not taking a discount. And we can work with those folks. And so having that knowledge is really key as you move.
Well, I think one thing that's important, Joe, that you do in the 3-day class that really brings it home is the case studies. The Dan Walters of the world and Jay Reddings and what they've done. And, just regular guys who pivoted and said, here was the problem. How did Notes solve it? And you guys kind of held their hand along the way too. So
I'll finish with one quick story about Dan Walters. Dan is in Boise, Ohio, or Boise, Idaho.
Right.
And so he brought a deal to the deal. I mean, you may have seen that, but Tom, he found the most burnout landlord that I've ever heard of. So this guy has 4 duplexes. He has 2 single family homes, and he was referred to Dan because this local realtor that Dan knew knew that Dan did creative financing. And so this guy wanted to sell these. So as these became empty, he would not even re-rent them. He has 10 units, nobody in them. They're free and clear, right? He's owned them since the 80s, but he's paying the taxes and insurance on them. He says, I'm not putting another tenant in those properties. He says, I'll sell them. And, this was a $2.5 million deal. And his tax, his depreciation, his recapture, and his capital gains, significant.
Yeah.
And Dan is working with him on making that happen. But you may not think that's a deal, but there are a lot of people out there that are like, I just don't want to deal with it anymore.
Yeah. So I think the closing statement is, if you're frustrated in any aspect of real estate, you want to come check out Noteschool. Come to the masterclass. I mean, it's 2 hours. You can sign up for it, and if you miss it live, you'll get the replay. Kind of see where we're going with this. If you enjoyed any part of this, if it's whet your appetite a little bit, doesn't cost anything to go. I've got free tickets for you. They're limited, but we'll do it again the following month.
Yeah.
And then if you decide that something worth looking at, hey, invest a little bit in your future. I did, and the payoff. I tell people my investment in the Noteschool ecosphere has already been paid off many times over, just with a couple of deals that I did. I think you've gotten to know Joe here. Joe's the real deal, and a treasure trove of knowledge. But the folks at Noteschool they want to see everybody succeed. We're part of a
We
family.
stand for your success. That is my motto, right?
Absolutely.
Yep.
So, Joe, anything else to say before we go? I do appreciate you being here today, buddy.
Tom, I appreciate you. I appreciate what you're doing in your business, and you're just a you're a model note school person, and you bring so much integrity into what you do, and you teach that, and you bring that to this podcast and your business. And kudos to you for
Thank you, Joe.
for what you've done and what you've been able to build in a very short period of time.
Well,
Yeah, you
done it without you
were
guys.
investor. You were one of the investors. You were the investor of the year.
Yes, I was. And
Yeah.
and like I said when I was on Note School TV with Eddie, was that that's a testament to you guys, because I am very risk averse, which is great as a pilot, not so much when it comes investing. And folks don't know that Joe was a commercial airline pilot for a short while as well, but he saw the light early and got out and invested in real estate instead.
I did, and I thought when I do it, I said, you only have to fly 80 hours a month, so you got all that off time.
That's right.
So I want to do that, and fly, and I want to do this too. And I realized it wasn't really like that, Tom.
Yep. But you're lucky you found it. You found the note business early. I'm trying to do that with everybody else, and so the more people I can bring in the ecosphere, that'll be great. So check out Note School. Get with Joe. And Joe, if people want to reach out to you directly, is that okay? Is there a way to reach you?
Joe at noteschool.com. Joe
Pretty
at
simple.
noteschool.com. And Eddie would love to have you in one of our master classes. So take Tom up on his offer there. That's a good offer, Tom.
It is. It doesn't get any better than that. It doesn't cost you anything. Just a little bit of time. But
Absolutely.
the couple hours that I invested changed the trajectory of my life and that of my family. So,
okay,
Joe, thanks so much. I appreciate it.
Thank you so much. Thanks, everybody. Look forward
We'll
to
be
seeing
back
you
in
soon.
just on the other side of this commercial break. I'll give you the link for those tickets, and we'll wrap it up. Thanks again, Joe.
Thank you.
Looking to buy real estate but don't know where to start? Since 2010, Danny Force with Keller Williams has helped hundreds of first-time buyers and investors begin their real estate journey. Danny has sold over $100 million in his career in all corners of the Dallas-Fort Worth Metroplex. He has the knowledge, experience, and connections to make this as stress-free a process as possible. Finding properties, setting up showings, and negotiating offers are just some of the things he can do for you. Come talk to Danny today at 817-518-7606 and use the Force in real estate today.
Well, like I said, Joe and I could talk notes for hours. He's just that kind of guy, and he's full of information. Hopefully you got a lot out of the discussion today. Take the next steps. If this has been interesting to you, there's a couple things you can do. Like I said, go to noteclubusa.com/CF and see a little bit more on performing notes, how I use them for my retirement funds, and what happens when notes go bad and how you get out of that, and how you can use all sorts of tax advantage ways to invest. And then take it to the next level. If you're wondering how you're going to make money in this upside down market, whether you're a realtor, investor, wholesaler whose buyer pool is dried up, you need to know these skills, and we're going to get you an intro for free. So after this little segment here, we're gonna fade out, go to the outro, and in there I'm going to have a link to the masterclass, which is March 29th. It's 11 to 1 Central Time. Please sign up, even if you can't make it live. I want you to see the replay. Find out if this is for you, and then see about taking the next steps to learn a bit more. I don't teach any classes. I don't sell anything as far as education here on this side. I'm just kind of a conduit to get you the information you need. I'm looking more for business partners who are educated in this space so we can do business together. And so I rely on Note School and folks like Joe to go ahead and get people fully up to speed on this. So we'll have that link there. Basically, you're going to email me at tom@noteclubusa.com. And if we have any seats left for the upcoming event, I'll get you a couple. If not, we'll get you scheduled for the next one. But don't wonder what would have happened. I always say that, the best time to have done this was about 20 years ago. The next best time to do it is now. So don't wait. Find out why Eddie is overbooked with folks trying to find out more about the note space and why they're getting into the note space and pivoting during these tumultuous times. So anyway, that's a wrap for today. Please go to noteclubusa.com, go to our podcast section, send in questions. That drives a lot of the content that we have. I've got a great guest scheduled for 2 weeks from now, and we'd like to answer your questions here live. on the podcast. So please keep them coming. And we look forward to seeing you next time. Till then, appreciate you being here. Go ahead and sign up for the masterclass, and hopefully we'll get to do business sometime. So anyway, just like to have the information. So have a good one. And until next time, take care.